Good afternoon. This is Eric Levinson, Head of Business Development for Vina Capital. I'm joined today with Tao Ung. Tao is Portfolio Manager of the VVF, which is our UCITS fund based in Luxembourg. And so we're going to do a review today, kind of a mixture of looking back and more importantly, looking forward. So congratulations and thank you. As a shareholder, 2021 was another fantastic year for the fund. Can you just maybe walk us through performance for 2021 and what led to such great performance?
Well, 2021 was a very strong year for the fund as well as the market. Class A NAV per share of the fund increased 49.5% in USD terms, far outperforming the benchmark VN index, which returned 37.3% in the year. So this has brought the 3-year annualized return of the fund to 22.5% versus 19.5% of the VN index. Top performing sectors that contributed to the fund's return included financials, information technology, real estate, and materials. All these sectors were driven by strong earnings growth during the year. And for the first 2 months of 2022, the fund also delivered a positive return of 1.8%, whereas the VN index declined 0.3% in USD terms.
Interesting. And so, I think a lot of people are looking at the market today versus last year. So here we are on March 1st. The first couple of months, we had kind of a slowdown in terms of kind of everyone waiting for the Tet holiday. So what's been going on in the market year to date? And as you look at 2022, how do you think it will be different?
Vietnam stock market saw increased volatility in the first 2 months of 2022. First, it was due to profit-taking pressure from retail investors before a long Lunar New Year holiday. And then we got the global inflation concerns, though headline CPI in Vietnam remained in check at 1.4% year-on-year in February 2022. And together with that, there is the expectation for global interest rate to be moving up faster. And also recently, we got the war in Ukraine, which led to higher oil price and a possible higher input price for some companies on the stock exchange. All this has affected the market sentiment.
So as we think about 2022, so the first 2 months, we've almost seen kind of everybody's almost taking a wait and see approach as to what's going to happen. Mm-hmm. Okay, now here we are in March. Obviously we can't really know what's going to happen in Russia, Ukraine, but the other things we kind of are either in the past or we kind of have a better idea. What do you think will happen the remainder of the year, and why will it be different if it will be different?
We think for 2022, it could be different in the sense that we would focus more on the recovery story post-COVID. Because we think Vietnam stock market will continue to benefit from a rebound of the economy this year, with GDP growth is forecast at 6.5 to 7% in 2022, compared with just 2.6% in 2021 because of COVID lockdown. In the meantime, corporate earnings will likely be the most important driver of equity returns in this year. Given the forecast EPS growth of 20 to 25%, the market valuation of VN index looks reasonable at 14 times PE 2022. However, as mentioned earlier, 2022 could be more challenging for investors than the last 2 years. We think there will be more dispersion among stocks in terms of outlook and earning growth, as well as more volatility from external factors that may affect the investor sentiment. Therefore, stock picking could be more critical to achieve alpha for the fund, as we have seen in the first 2 months of this year.
So now, Tao, I know you and the team, we talk about how we invest, we're absolutely bottom-up fundamental investors. Having said that, we absolutely pay attention to macro trends and certain themes. From a thematic standpoint, is 2022 a continuation of certain themes? Are there new themes that are emerging in the portfolio?
For 2022, looking at the sector's outlook, we remain bullish on Vietnam banking sectors, given strong credit growth, rising fee incomes, stabilized as well as easing provision. We expect the banks to maintain steady profit growth of around 25% on average in 2022, thanks to robust demand post-COVID recovery. But not all banks are equal. So we prefer banks with competitive business models, good asset quality, increasing digital efforts like Vietcombank, Techcombank, or MB Bank, or banks with specific story like turnaround or selling to strategic partners like VP Bank and Sacombank. Looking at real estate sectors, we expect to see the continued growth of residential market in 2022 as many large residential developers resume their plans and project development after a low base in 2021. However, given the stretched valuation of some real estate companies after a very good rally in the second half last year, we will only focus on selective real estate companies with good land bank, visible selling plan, and reasonable NRV valuations. Regarding another sector that we have been holding in the portfolio, that is information technology, FPT remain our core holding convictions with long runway to growth. The company guides at 20% earnings growth for 2022, driven by its software and education businesses. Another theme that emerges this year, which is consumer discretionary. As I mentioned earlier, we focus on a recovery story in this year. So we expect to see a recovery or a rebound in discretionary spending, given less COVID disruption risk and high vaccination rates among the population. So consumer discretionary companies, including retailers and distributors in mobile phone or electronic devices, as well as jewelry, they all target profit growth from 25 to 30% for 2022. And also, we think companies with pricing power in an inflationary environment like this year will also perform relatively well.
So when you're thinking about companies with pricing power, is that because they're a more well-known brand or they just have better products?
I think it's a combination of both factors, because if you have a well-known brand and a good product, you can transfer the higher input price to the end users, and that your margin or your profitability will not be affected as much as other companies.
Excellent. So as we think about this year, one of the questions that we often get is, does your strategy lend itself well to the environment today? So knowing that you and the fund is kind of a GARP, growth at a reasonable price, is this kind of market coming off a market in 2020, market was up 15%, 2021 the market's up 31%, and you outperformed in both years. Is the market where we are today kind of good for your approach?
I think yes, because this year we think that stock selection could be more critical and important to generate alpha for the fund. So we have not changed anything fundamental to our investment process. We are loyal to our philosophy that buying growth companies at reasonable prices. At the moment, the fund's portfolio is traded at 10.5 times earnings in 2022, with projected 40% EPS growth.
So hold on, I'm going to stop you there because earlier you said the market's at 14, and so the market's at 14 and the fund is at 10.
Yep.
And I believe consensus earnings are at 25 and portfolio average earnings are at 40.
So you can say that the portfolio is around 30% cheaper than the overall market, while EPS growth is almost double on the overall market.
Okay. And it's not always like that. That's great.
Because as we move into 2022, we deliberately position our portfolio into companies that have higher growth and repeatable, visible cash flows. In the meantime, we reduce a few positions that have diminishing visibility or growth outlook. We are comfortable with the companies in the portfolio right now. And given the variations that we are starting with, we think the fund should continue to outperform. However, we are not complacent. We will continuously test our conviction for the portfolio companies as well as our investment thesis, so that and monitor the global events around us, so that we can make the adjustment accordingly and in time.
Well, thank you very much. Appreciate the insights. And one other point I wanted to make, so we've looked at our peers and we've gotten feedback from clients, and so we'll be cleaning up our share classes of the fund, and importantly, as of January 1st, we've removed any performance fee from any of the existing share classes. So for those of you that are current shareholders, it's terrific. For those of you that are evaluating the fund, we'll have fewer share classes and there will be no performance fee for VVF going forward. Again, if you have any future questions, please let us know. Thank you very much for your support.
Thank you.